Inflation continued to cool in June, rising at the slowest annual rate since March of 2021. Year over year, we saw core CPI rise just 3%.
CPI for the month of June came in at 3%. This article is from Reuters, guys. U.S. economy shifts into disinflation mode. Consumer prices rise modestly, and consumer price index increases 0.2% in June. CPI climbs 3% year on year, smallest rise since 2021. Core CPI gains 0.2%, up 4.8% year on year. U.S. consumer prices rose modestly in June and registered their smallest annual increases in more than 2 years, as inflation subsided further, but probably not fast enough to dissuade the Federal Reserve from resuming raising interest rates this month. The report from the Labor Department on Wednesday also showed underlying consumer prices posting their smallest monthly gains since August of 2021. The considerable slowdown in underlying inflation sparked a rally on the stock and bonds market, with investors convinced the U.S. central bank's fastest monetary policy tightening cycle since the 1980s was drawing to a close. Quote, inflation insists dead, but the extraordinary pandemic push on prices from shortage and shift to stay-at-home purchases in clearly, and the Fed for the first time has the upper hand in its inflation fight, end of quote, said Christopher Rupsky, chief economist at FWD Bonds in New York. The CPI gained 0.2% last month after ending up 0.1% in May shelter, which includes rent, accounted for 70% of the rise in CPI last month. There were also increases in motor vehicle insurances, as well as gasoline prices, which rose 1%. These gains offset a decrease in the prices of used cars and trucks. Food prices ticked up just 0.1%. Grocery food prices were unchanged, and further declines in the cost of eggs, as well as cheaper meat and fish, which offset a 0.8% increase, but it still costs more to eat out. Annual inflation is a third of what it was last June, when prices surged 9.1%, which was the biggest increase since November of 1981, and marked a peak on the year-to-year CPI rate. Nevertheless, inflation remains well above the Fed's 2% target, with the labor markets still tight. So let's see more, guys, live and in action to get more information on this. Moving forward, editors, roll clip, fair use.
Up 0.2%, up 0.2%. And that, of course, comps to the up 1/10 in the rearview mirror. It's a 1/10 lighter than expectations. Now, CPI core, ex-food and energy, up 0.2, up 0.2. And that means it's not the fourth consecutive month up 0.4. And it also means it's not the seventh month in a row of 0.4 or higher. And that was a record going all the way back. The last time we had something along those lines was from October of 89 to April of 90, where it was 9 in a row. So we stopped that as well. And up 0.2 on the core is the lowest level going all the way back to February of 21, when it was only up 1/10. And if we look at year over year, up 3%. 4% in the rearview mirror. Well, 4% in the rearview mirror was the lowest level since March of 21. So when you see 3%, you have to go all the way back to March of 21 again, because that's where the comp drops from down to 2.6 is what we're comping to. And in the rearview mirror, 4%. And here's another one. If you look at ex-food and energy, last month it was up 5.3. That was the lowest level since Nova of 2021. We breached 5% to 4.8. 4.8, and that remains at the lowest level since October of 21, when it was 4.6. We could see that interest rates have fallen about 3 basis points in tens, from 393 to 390. We see that the pre-opening equity markets have rocketed higher. Dow futures up basically 200. And of course, we are going to monitor if there's any changes in Fed fund futures. I don't think so. At 10 o'clock Eastern, look for Bank of Canada to go 1/4 point to 5%. Dollar index prior to this number, of course, was at a 2-month low. My guess is it's not rallying at this point, and we're all going to pay attention to the UAW. You know, wages are a big issue, as we learned last Friday, and UAW and strikes and minimum wages across the country. All of those things may be good for many people, but there's very little doubt that they also fuel some wage inflation. We need to pay very close attention to that. Joe, all yours.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a quarter percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers.
Hey guys, it's Jose, your regular Joe Blow again, keeping an eye out and my ears open to the recent CPI numbers. As always, excluding food and energy. And that's why it looks like CPI is coming down. But doesn't feel like it, guys. And since you guys are on this channel, you guys are prepared. You know what we do here. We continue to apply knowledge, thrive, and get better. Guys, keep doing your own research and scaling at everything possible. And don't forget to anchor at all levels. You guys are truly a blessing. Thank you guys for letting me work to do my best to bring you my best. You could be spending your time anywhere else, but you're here, and I appreciate that. Thank you very much. Much appreciated, guys. Stay free.
It ain't hard to tell. I excel, then prevail.